Welcome back to Financial Fortitude. I'm Michael Acosta, joined as always by my co-host Brady Hemmerly. A few episodes ago, we unpacked one of the most misunderstood but increasingly used tools among high earners and investors, the Securities-Backed Line of Credit, or SBLOC for short.
That episode generated a lot of follow-up questions because once people understood what an SBLOC was, the natural next question becomes, how does this actually work in real life or apply to my situation?
So today's conversation is about application, not theory. We're building off episode 25 and walking through real-world case studies that show how SBLOCs can be leveraged to create liquidity, preserve portfolios, and help achieve other financial goals without triggering unnecessary taxes or forcing emotional investment decisions.
And just as importantly, we're also going to talk about where SBLOCs can go wrong. This is a powerful tool, but only when used with intentionality, with clear guardrails, and as a part of a broader financial plan.
If you're thinking about access to capital, flexibility, or how to avoid selling investments at the wrong time, this episode will help you understand how wealthy families actually use SBLOCs and when they shouldn't. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I'm pretty excited to work through today's episode because this is one of the few that we had so much feedback on that it actually prompted another deeper dive type episode. And it's much more applicable to situations that we're seeing on a day-to-day basis. And so I'm hoping that as listeners are basically consuming our episode today, they pull out, hey, I know someone who was in this situation, could have used this as a tool, or maybe, hey, I'm in this situation and this sounds like a great tool that I should consider.
Yeah, this was a great episode that we did back in episode 25. That was a lot of fun. And you're right, it was one of our best performing episodes. So the fact that we're here doing a 2.0 version in my mind, I think is very exciting to actually peel back the onion a little bit further and walk through a couple case studies. Because in the first episode, it was more about what is an SBLOC? What is it compared to as far as other tools or solutions on our balance sheet, right? In comparison to home equity lines of credit, 401k loans, things of that nature. But how does it actually work? Yes, in theory, that's great. But when we can walk through actual scenarios, we as listeners or an audience can actually self-associate better and be like, oh, this might be the circumstance that fits the right occasion for me because of where I'm at. I'm very similar to what happened in that specific case study.
So let's, for any listeners who have not yet got a chance to go back to episode 25, can you briefly remind everybody what is an SBLOC, just very basics?
All right, so when breaking down the actual definition of what a securities-backed line of credit is, I like to be a little bit more technical in nature, of course, personality-wise. So I'm going to go to a great resource as far as Investopedia and give you their definition. So a securities-backed line of credit, SBLOC for short, is a revolving, non-purpose loan allowing investors to borrow against the value of their portfolio. So think about stocks or bonds, rather than liquidating assets. This is typically offered by banks or broker-dealers. It provides quick, flexible capital for expenses like luxury purchases of real estate, often at a lower variable interest rate. Now, one of the key benefits and reminder for our audience as far as why a securities-backed line of credit might make sense is if you are a high earner and a couple things. One, do not want to give up control of your asset that's performing well. You want to continue to hold on to it, especially if the hurdle rate or the arbitrage is in your favor, meaning the interest that's due on the securities-backed line of credit that's used is less than the rate at which your assets are growing or performing. Okay, in that case, it makes sense in my mind to leverage the debt or leverage the asset and take on the debt. The other is you don't want to actually trigger a capital gains event, whether it's short-term or long-term, because securities-backed lines of credit are typically tied to non-qualified, non-retirement type investment accounts. So these are dollars that have already been taxed, getting put back into the investment world. But then if you were selling the investment at a later date, you're either going to run into short-term or long-term capital gains, depending on how long you actually held the investment before you sell it. Anything you'd add to that, Brady?
No, I think big picture, what I'm hearing is it is effectively a variable interest rate loan that's collateralized or tied back to only your non-retirement accounts.
Correct.
Using the loan allows you to pull money from the line itself in cash rather than selling out of investments, getting out of the market itself. So just another tool that's attached to your investment account as opposed to attached to your home or another asset.
Correct. And that's why I think in episode 25, that's titled How the Wealthy Use SBLOCs to Borrow Tax-Free Without Selling, is powerful in nature. If you haven't listened to it, go back and listen to it and give us your thoughts. Like it, share it, leave a comment or a review. But it's really breaking down what an SBLOC is. And again, it's comparing it to other like-kind solutions or strategies where the home equity line of credit comes in. Big differentiator that we highlight in episode 25 is that in setting up a home equity line of credit, there's typically a fee involved from a closing standpoint. With a securities-backed line of credit, there's traditionally no fee or expense on getting that set up through your provider.
Let's jump right into some real-world examples. So, Michael, I'll open the floor more so to you. Tell us more about an instance where you've seen a client or an individual actually step in and use an SBLOC. Why did they do it? How did it work? What value or benefit did it provide?
Yeah, so this is going to be case study number 1. In my mind, the theme of this is liquidity without liquidation, right? Another way of saying that is getting access to capital without giving up control of your assets. And so the sub case studies that I will reference in regards to this specific theme are primarily tied to 2 specific events. One is the purchase of real estate, okay, for one core group of clients. The other one is the buying in of equity into a business as a partner, minority share partner, okay? So let's start with the real estate first, because that one's pretty cut and dry and straightforward. What we did here is we had a client, mid-30s, and they had squirreled away a decent amount in a non-qualified taxable investment account. And they also had set aside some funds for a down payment on a home. And of course, when they purchased their home about a year and a half ago, the housing market was still at a peak as far as real estate prices went. But we did not want to have to use any capital above and beyond what we had set aside in their home down payment bucket. Okay. So we were needing, let's call it another $30,000 on top of what we had already set aside. And we ran the numbers to say, okay, does it make sense to go into this non-qualified investment account that at least up to this point has been performing very well, double-digit returns because the last 3 years in the U.S. market have been relatively strong, double digits. And we said, okay, do we want to go in and liquidate $30,000, giving up control of future growth on these $30,000 in exchange for the full down payment to get the monthly mortgage payment lower? Or do we leverage your securities-backed line of credit that we had set up just in the event that we needed access to capital that had a variable APR interest rate of about 6.5%? Now, if we're going to be, comparing apples to apples, this portfolio for the client generated around a 16.5% return for 2025. Well, the variable rate again is 6.57%. So it's with ease at this point, outpacing that hurdle rate, and very easily.
So as an example, in 2025, the client paid, let's call it 6.5% interest on $30,000, but that same $30,000 generated 16.5% worth of gains or extra money in their pocket.
Exactly. And so, we've been paying back towards this note for about a year now, but what's brilliant for us is that we've been able to take the monthly dividends and interest that the portfolio is producing. We'll call it a 85% equity, 15% bond type of allocation. And it's more so focused on dividend paying equities. And so we're taking the dividends and interest that it's accumulating each month and applying it towards the SBLOC itself for interest and principal payment contributions. So the amount of dividends and interest that the portfolio is producing at this point is greater than the interest-only payment that's due. And again, referring back to episode 25, with SBLOCs, you can make interest-only payments until perpetuity if you want to. Now, this young client just had their first child, and so there was a lot going on from a life events perspective. Buying their first home, preparing for their first child, the primary breadwinner in the home. Some of the income is variable driven just based on, being in a role where there's base plus incentive compensation. So the name of the game for us with how we were addressing this was, okay, well, we're going to use the SBLOC. We're going to take the dividends and interest to apply towards interest only plus some, depending on what we're able to produce. And then whenever we get incentive compensation payouts, we're going to take a percentage of that and throw it at the SBLOC loan just to accelerate the paydown. Now, again, because of where markets have been and what we've been able to produce by way of portfolio allocation, there's not a huge urgency to pay this back because we're, again, in a meaningful manner outpacing the hurdle rate of 6.57% as far as the interest rate that's due on the outstanding balance.
Got it. So what I'm hearing is client had funds prepared for a down payment. Their home was either at peak price or perhaps they stepped just into the edge of their budget from a down payment perspective. Rather than giving up control of the assets, rather than paying taxes on a sale loaned against their portfolio, were able to come forth with the total down payment that made sense based on their situation. And then they've got a lot of flexibility when it comes to paying the loan back because the portfolio is addressing it and they can attack it basically in a manner that is most comfortable for them based on where all of their life events are.
Correct.
So tell us then, coming out a year and a half plus, what value have these clients seen from using the SBLOC in this scenario? What are things that you've heard or things that they've shared with you about making the choice and then actually taking action?
So some of the biggest value add is just the additional safety net or emergency bucket that they have of capital available to them above and beyond the $30,000 outstanding line of balance that they started out with. The other is that because they're not necessarily needing to make monthly payments towards it from their cash flow, it's really out of sight, out of mind, almost similar in nature to a 401k plan with your employer, except instead of having your 401k balance go up, we're seeing this SBLOC balance go down. And again, a lot of that has to do with the size of their non-qualified account. And so that's helpful. And just to give a range, this portfolio value is between $200,000 and $300,000 in value. The other thing, again, is that portfolio last year, to be exact, grew by 16.7%. That's sizable, right? That's great. And so they have an overabundance of confidence because they're seeing the port value go up despite that SBLOC being tied to it. Now, again, $30,000 loan outstanding is very nominal in comparison to the overall value of the portfolio. We've told the client, hey, if we ever get to a point to where we just want to liquidate the remaining balance from the investment portfolio and throw it at the balance, we can. But again, there's no sense of urgency because of what markets have been able to offer us up to this point. And it just makes sense to leave the funds in there continuing to grow, compound, and in my mind, marinate for other goals and opportunities that might come available. The other thing is that we didn't have to trigger any sort of long-term capital gains or short-term capital gains event. So it was very tax efficient. And the biggest takeaway is that, hey, we achieved one of the shorter term goals that we discussed when we started our planning relationship. And it was, we want to be able to purchase a home. And when we went into, when we were discussing with the client, the types of homes that they were looking at, there were some that were like, okay, we would be conceding some of the aesthetics that we really want. And it was really a conversation of, okay, well, instead of going with the lower priced home and giving up some of the things that we truly desire or appreciate, let's spend slightly more. We're still within the guidelines of, the rules of thumbs that we recommend when going and finding the right mortgage and the right home amount. But we're not going to have to give up any of your investments to actually make this dream become a reality. Because I know when I bought my first home with my wife, looking back on it, we wish we would have spent a little bit more money to get the things that we truly wanted. Hindsight, right? But in the moment, it was one of the largest purchases that we had to make. And we weren't in the same position to have the SBLOC readily available.
Got it. So let's phase into your business owner example. Tell me more about what that situation looked like, where the SBLOC came into play, and what the outcome has generally been.
In reference to the client who was presented the opportunity to become a minority partner in a business here locally in Charlotte, young professional, high performing, married, 2 young children, just had their second child in the middle of last year. So going through some life events, right? And was presented this opportunity in Q4 of 2025. Balance sheet wise and very well positioned. They've always done a great job in how they've budgeted as far as a household and as a power couple. Student loans on the book. So one of our, what I would call textbook clients, of where we're not letting that federal student loan debt hemorrhage us or keep us from being able to achieve other goals and opportunities. But when looking at their overall balance sheet, a lot of their wealth was really tied up across 3 specific asset buckets in my mind. One was going to be non-qualified investments jointly held. Second one was going to be retirement assets based on the student loan strategy and working towards public service loan forgiveness. And the third one was real estate, having recently moved into a bigger home for their family to grow into within the last, call it 12 to 18 months. Okay. The biggest priority was one, we have been waiting to look for an opportunity to refinance to get their mortgage rate down to be more attractive than what it was based on when they purchased the home, again, 12 to 18 months ago, right? So interest rates were probably upper sixes to mid to upper sevens. Not ideal, but not historically crazy high rate. We didn't want to give up control of the liquidity because, again, my opinion is that I would rather spend someone else's money and maintain flexibility and control of my decisions versus giving up control of my asset and now being left with very little flexibility or decision or opportunities to make adjustments. Because once you give it up, you can't get it back. And so the portfolio value that we have for the client, again, I'm going to give a range, is between $125,000 and $200,000. So we set up the securities-backed line of credit knowing that, hey, this client had interest in buying into the business that he's been working at for the last couple years, feeling very optimistic about the business and the trajectory of it, and was given the opportunity to buy 10% equity. So when looking at avenues, we said, okay, do we want to go get a business loan for you to do this? What are the interest rates? Do we want to leverage the home equity line of credit? They didn't have one set up, so we would have to have closing costs. Or do we want to set up a securities-backed line of credit? Again, no cost to getting this set up aside from a hard credit pool. The biggest hurdle that we ran into with this was that the credit history or credit reporting was frozen, so the client had to get that undone, right? But very seamless, simple process for them. So in this specific scenario, the actual amount that we took out, and let's just call it a loan, I'm going to give a round number, was about $60,000. So bought in, and we used $60,000 from the securities-backed line of credit, and we'll call it another $20,000 to $30,000 from personal savings, just to be able to split the difference and lean more into this variable rate. The variable rate on this line of credit was 6.57%. So again, very attractive in nature. Obviously, it's variable driven, but over the course of the last year or so, we've seen the Fed cut rates, which has softened the SOFR rate some, which is where these variable rates are tied to. So at this point, we're making a fixed recurring payment from cash flow, but also having the dividends and interest make additional payments above and beyond the interest only that's due. So similar in nature to the last case study that we discussed with the young client who purchased their first home, we're in no immediate rush to pay this back, still hitting our extraordinary wealth building savings rate of 15 to 20% of annual gross income. But now that this individual has a share in the business from an equity standpoint, they're now privy to owner distributions. So when we start getting owner distributions paid out, we're going to take a percentage of those and start throwing them at the securities-backed line of credit to accelerate the payoff. Now, we often refer back to what's the hurdle rate? What's the cost of doing this? What's the opportunity at hand? Well, this client's portfolio last year, which again is about 80 to 85% equity, about 15% or so fixed income, generated a 15.42% return. So again, strong return. That's roughly a 9% gain on the cost of these dollars. The difference between 15.42% and 6.57%. So about 9% is what they made on that decision. The idea here is that as the portfolio value continues to go up, in theory, the dividends that they receive should go up, which should then make it easier to accelerate the pay down of this outstanding balance. Now, one of my favorite features of the securities-backed line of credit is that there is no restrictive timeline on when you need to pay off the loan like a HELOC, home equity line of credit. There's no balloon payment due unless you run into a margin call situation, which I know we're going to talk about in the next case study.
What I'm hearing, at least between the differences of the two, is the first use of the SBLOC was really to purchase a goal-based asset. The second case study use of an SBLOC was to purchase, I would consider, a goal-based asset, but I would argue another income-generating asset.
Correct.
I'm basically taking a loan against money that I already have, growing and working, using that money to go buy into another asset, a small business in this case, and putting that money to work, growing and working, all while maintaining the flexibility of not high commitment payments, having the ability to help pay the loan back from the first asset that I'm borrowing against. I think that really goes deeper into your concept of velocity of money, right? Using one bucket of money to build another bucket of money without giving it up altogether.
And you're right. I mean, it was In this scenario, scenario one or case study number one, it's a goal-based asset with the sole purpose of it primarily being a place to live, start a family, create memories, and be protected from the elements, right? In that essence, it's not really an investment play. It's more of a goals acquisition. Scenario number two that we just went over, it was more of, okay, well, this can be a multiplying effect, a multiple effect, a leveling up effect. Why? Because for those who are high performing career-wise, who wouldn't want to become an equity owner in a business that's thriving and on the right trajectory if it's something that you have a lot of conviction and passion around? When you become an equity owner or a business owner, right, you get to sit at a different table and participate in different levels of revenue and income. So they now have a minority impact on the trajectory of where this business actually goes, and then they get to participate in the net profits. And so the idea is that over time, we're going to continue to leverage the SBLOC as needed to buy more and more equity stake in the business over the course of some sort of buyout schedule that will be determined between the one partner who's potentially going to be exiting the business over the course of, let's just call it, the next 5 to 8 years. So we can keep coming back to this honey hole, and as long as it is still advantageous based off of where interest rates are at and how the markets are performing, we can continue to stay here. Now, I will say in both of these scenarios, again, 2025, 2024, and 2023 in the markets, US-wise, have been very attractive, double-digit returns. If we're in a slower market period where, maybe tilting the portfolio to be more fixed income or bond-oriented, you may be breaking even with that hurdle rate. It really just becomes a question behaviorally and psychologically. Do we want to keep the asset on our balance sheet, or do we want to give up the asset and put it on someone else's balance sheet? I have a slight bias towards keeping it on my balance sheet just because I like to be in control and have optionality.
As long as it's a responsible choice.
Yeah,
right?
absolutely. There needs to be prudence with it, right?
Yep.
Now, Brady, up to this point, we've really highlighted how accumulators, I'll call them younger professionals in, middle, early phase of accumulation, have leveraged security-backed line of credit for their personal gain and their family and just achieving certain goals and milestones. I think you were going to share a case specific to someone who's either already approaching retirement or in retirement and how they were able to leverage a securities-backed line of credit in a successful manner.
Yeah, and I think it's a stark difference when you think through the world that those two different types of clients live in. For most younger, high-earning, peak profession years, the well financially just continues to get bigger and bigger. As our assets grow, as we are putting more money into the pot, right, as we are watching compound interest take an effect, the pot continues to get larger. So it drives some look at, does an SBLOC make sense when we're going off to accomplish a goal or to leverage into things further? For most, I would say pre-retirees, retirees, they have a good sense of, hey, the well that I've built or the size of my bucket, it's not really going to change all that much. The focus is now much more on how do I preserve the wealth that I've built? How do I make sure that I don't run out of dollars? And how do I continue to produce an income that allows me to live the life that I've dreamed for at this standpoint? So the look of those two different clients is quite different. And the effect that a large draw against a portfolio may have is also different. So the case study example that I have, it's two pre-retirees I would call new retirees. We just retired. We flipped on many of the income sources that we've spent the last 25 years building. It's time to sail off into the sunset and enjoy what retirement looks like. And for the first year of retirement, most everything was going to plan. Their portfolio had a good balance of risk, funds that were still growing for the long term and funds that were providing income and safety for the short term. But walk through a year in retirement, and what these clients found was we love spending time with our family at our home. Our home, the way at least that we had originally built it for retirement, is not accommodating enough to host as many people as we would like to outside. And with that in mind, the thought was, hey, we want to put a larger outdoor patio deck space on the property so more family can come and spend time with us, and as a family, we can spend more time outside. Great goal, right? Is, hey, we didn't know this before we actually crossed the retirement finish line, but now this is a new surprise that we find ourselves in, a good surprise. Now, these clients essentially had two different options, right? Option number one is we can take from the well, or we can essentially sell out of a chunk of our portfolio. We'll call the addition in this circumstance $75,000 to $100,000. We can take $75,000 to $100,000 off of the table or off of our portfolio and use that cash to effectively pay for the renovation and continue to enjoy retirement in the way that we've planned. Michael, what are your thoughts? What comes to mind initially on what the downsides of those choices might be?
Yeah, so one of the first questions that I was going to ask was, when figuring out whether or not it made sense to do the securities-backed line of credit, had you guys considered a home equity line of credit or even a secondary mortgage or like a construction loan of sorts that could be repackaged when comparing, the overall cost of the project?
Yeah, so we had thought through that. It was a newer mortgage. Clients are carrying a mortgage through retirement. Comes with closing costs, and clients are generally averse to additional debt on their home. That makes them worried knowing that the well's not getting bigger. We're not producing any more personal income. We don't want to over leverage the home that we have.
Right, because most retirees in nature want to, or at least have been programmed in entering retirement with no mortgage at all. Right, because a mortgage is going to be one of your biggest fixed expenses long term, right? So in thinking of that scenario, it is a pretty sizable notch relative to the fine details, which we're not going to get into out of respect for this case study. But, I think you said $175,000 or so was about the cost of the project.
So cost of the project was $75,000 to $100,000,
Okay.
But yeah, call it 5 to 10% of this client's entire nest egg.
Yeah. So in that scenario, I think it makes perfect sense. And I imagine the variable APR on that is going to be very similar in nature if we're using the exact same SBLOC provider. So then the question I guess I have, where this is a little bit different on the distribution or decumulation side of things versus the accumulation side of things, is what is the overall strategy at hand for paying back that line of credit? And did you have to repurpose or readjust the overall allocation of the assets?
Yeah, it's a good question. So that's ultimately the conversation that we had with these clients is, hey, option one, we can just take money right off the table, pay cash for this project. There's nothing else to really consider above and beyond that. The challenge is we're taking 5 to 10% of your nest egg off the table. And remember, that nest egg is now a component of their retirement income. So we take a piece of the nest egg off the table, we take a piece of their paycheck off the table going forward. And then in addition to that, this is portfolio money that you've been accumulating for quite a long time. So there's a pretty significant gain exposure to sell out of assets and effectively pay taxes. So thought with this particular client is, other option is we could just lend against your non-retirement or your brokerage account somewhere in the neighborhood of $500,000 to $600,000. Take the cash out of the brokerage account, use the SBLOC line to effectively pay for the renovation. And in doing so, you get to continue to keep the stock shares that you have and the bond shares that you have. You sidestep all of those gains taxes with a bucket that you've been accumulating for quite a while. And then, as Michael noted, we could reposition some of the portfolio to dividend-paying stocks, high-yield bond funds, to effectively allow most of the renovation to be self-service.
I think that makes perfect sense, and I love the way that it was positioned. And for those of you who are listening, when you get into your retirement years, I will say there's less of an emphasis on how is my portfolio doing by way of growth and more of how much money do I get to spend and is it producing enough income? And if you take $100,000 off the portfolio, that's $5,000 a year in extra income, assuming a 5% yield. So in the grand scheme of things, $5,000 might not sound like a lot for some people, but that could be an annual vacation for this couple, right? To be able to take their kids with them internationally or domestically or whatever.
And that's really what sold it to the client. Whether it comes off the table and sits in cash or whether it comes off the line wasn't as much of a question. Their biggest concern was, if we do this, how is it going to affect what our world looks like thereafter? We don't want to put this big addition onto the house and then basically be bootstrapped and living here for the next 3 to 5 years, waiting for our portfolio to hopefully come back to where it was so we could go off and take those next few trips. Right. Assets are limited. The pot is only so big. And for many pre-retirees, time is limited. Right? You can't travel the world. You're not at your best health in your 80s, 90s. You want to do a lot of that stuff in 60s, 70s.
Right. During the go-go years is what they refer to as. Now, I love that because, again, if I had to sum it up, it was flexibility and optionality. Also knowing that if you refer back to one of our inheritance or estate planning episodes that we've done, that there are benefits to the securities-backed line of credit as far as when someone inherits the account with the securities-backed line of credit on it. There's still optionality there as to whether or not you pay the line of credit off back in full, or does that outstanding balance just transfer on the account to the person who inherited it, and then they're getting a step up in basis in that account. So then there's some tax efficiency there for them. That might actually be an episode that we come back to as like a 3.0 with SBLOCs and kind of blending in or having some sort of fusion with estate planning and inheritance, because I think that could be a lot of fun.
Yeah. So we've talked through at least 3 case studies here, and probably for the case of the episode, all of them worked out pretty positively. I don't think we'd first share 3 negative outcomes, but given how positive all of these outcomes looked and sounded, what things do clients need to think about from a consideration or a risk standpoint before jumping right in and just leveraging as much of their portfolio every time something comes up?
Yeah, so that's actually a really good segue into case study theme number 2, which is strategic flexibility during market volatility, right? Like, yes, we can talk about all the glamour of having a securities-backed line of credit set up as a secondary emergency fund, as access to capital with very little cost entry-wise of getting it established, even if you're not going to use it. And yes, how when markets are going up, it's a great solution. We touched that at a very small amount as far as if you're breaking even from as far as the APR, the cost of the outstanding balance versus what you're actually yielding or growing your portfolio on. But we didn't talk about what if you're losing portfolio value. That is where the biggest risk comes in, but there are still opportunities at hand, and I like to refer to it as beautiful collateral. And what I mean by that is if your portfolio value is dropping, you have an option if you're at least in the distribution phase, right? So let's go back and let's put our frame of mind on the retiree couple. In that scenario, if the market's dropping, let's just call it 10%, and they're now taking out another 10% of their portfolio to build out this addition, which is going to provide them the value add of what? Being able to host more people, which fills up their bucket, having more experiences in their home, being able to continue to have similar income output that they would have had with no addition, to be able to then go and travel and do all these other things. Well, if the market drops 10 and they're experiencing lockstep loss in portfolio value plus taking out another 10%, well, their portfolio just got reduced by how much?
20% in 1 year.
20% in 1 year.
Income's been cut by a fifth at this point.
Right. And we like to refer to that as sequence of return risk. And so from a sequence of return risk standpoint, if I were going to very simply define that without referring to a specific resource or, Webster definition, it's really just how events occur off one another, right? Or when events occur and the ripple effect or the compounding effect that they have on the overall picture, right? And you use an analogy that I really love in client consultations to where if we're looking at a client's balance sheet and we're making a decision on the balance sheet, it's the equivalent of taking a pebble, throwing it into a still pond, and seeing the rippling effect kind of grow across the pond in certain areas. Same thing happens with your balance sheet. So in the scenario of strategic flexibility during market volatility, well, probably don't want to more aggressively decrease the value of our portfolio by taking 10% out while also experiencing a 10% loss. So what could we do in theory? Well, in that scenario, we could leverage a quote unquote liquidity bucket, which in this case is the securities-backed line of credit, borrow against the portfolio, the 10% that we needed for the home renovation. Yes, the portfolio value's gone down, so the amount of interest and dividend that the portfolio is kicking off to help pay back the loan may be reduced some, but you still technically own the assets so that when the markets recover, it's recovering at a greater compounding effect in my mind versus having the 10% less in value from the distribution, but then also the market loss on top.
Yeah, so what I'm hearing there is the SBLOC can absolutely be used as a tool even when things aren't going fantastically well. But when things aren't going fantastically well, that's when your biggest risks exist, right? If I'm losing value in my portfolio, I may not actually experience that positive interest arbitrage that we're talking about, where my portfolio generates more wealth than I'm actually paying in interest. If my portfolio drops too much or my line is too large, I could be responsible for basically settling up with the line of credit in a margin call scenario. to continue to actually use the tool without having to sell out of my assets and clear everything off the slate. So
one thing I would add to that, not to cut you off, is that in a scenario where, let's just say it's $200,000 in portfolio value, 10% market reduction, right? That means the portfolio dropped by how much? $20,000. So we now have a portfolio value of $180,000. Well, if I take out the line of credit, my portfolio value is still at that $180,000, even though that there's a line of outstanding balance on that line of credit. Well, if the market rebounds over the course of, let's call it 12 to 36 months, and the portfolio is now valued at like $280,000, right? Or maybe it's valued at $300,000. Well, now I get to come back to the table with my financial advisor and have the conversation of, do we liquidate $100,000 or $75,000 from the portfolio to make a lump sum payment towards the securities-backed line of credit? Or do I continue to carry the outstanding balance and pay it back by way of cash flow and or dividends and interest from the portfolio? Whatever you guys have designed between you and your advisory team. That highlights the optionality and flexibility. And I think that's something that's very hard to quantify by way of value, because it's more so of behavioral and psychological in my mind.
So Michael, what I'm taking out of things is the SBLOC itself is, I would say, a multifaceted tool. It can be used to accomplish a variety of goals in a variety of situations with a number of different outcomes, depending on what's most important to the client. And when things are going positive in a client's world, in the market, with interest rate environments, right, it typically leads to positive outcomes. But there are plenty of instances where if things in the market, interest rates, client situation is not going precisely as planned, there are some risks involved in having a financial professional in your world to help assess what the ongoing plan of action is and where we stand from a risk profile standpoint makes all of the difference.
Absolutely.
So I think to sum up our episode here, what I'd say is that SBLOCs aren't necessarily just borrowing for the sake of borrowing. They're about creating flexibility, optionality, and really control, especially when markets or life don't move in straight lines, or perhaps there are multiple different goals that we're looking to accomplish.
Absolutely. And I think that's where the humanization of all this really comes into play, and how not every decision can be made from the output of a spreadsheet. And so SBLOCs, when used correctly, can act as a financial shock absorber, right? Surge protector, giving you a helping hand with being able to access capital without dismantling a long-term investment plan. So when used incorrectly, though, it can magnify risks unnecessarily, which is why strategy and discipline matters and where you should consult with your trusted financial representative.
If you found this episode helpful, or perhaps you're now thinking differently about liquidity and access to capital, please subscribe to our podcast, leave us a review, and share this episode with someone who you think could benefit.
And if you have a personal question or topics you'd like us to riff on or break down in future episodes, submit them at our Ask Me Anything page, which can be found at www.genesiswealthplanning.com/AMA. If you're wondering whether an SBLOC fits into your own situation, that's exactly the kind of planning conversations we help guide clients through. So feel free to reach out. And as always, thank you for listening to Financial Fortitude. Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077. 7237198.29, expiration 228.